Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the Monday, the 29th of September, Bull versus Bear webinar. Steve Miley here on the call for trade day. Welcome, everyone. We'll go through our usual run through in here today with the slight twist for a Monday where we take a look at what I like to call the shape of the week. So we'll take a look not only back at what we saw last week on the main macro fundamental geopolitical and fundamental events that are shaping financial markets right now, but also looking ahead to what could be shaping them going into this week. We do this even though we're day trading at trade day because it can affect where we have different maybe points coming up in the week. It's going to affect volatility not only going forward around those events, but also potentially affecting volatility now. So we've got a lot of big events coming up. It might mean that you have more volatility potentially in the future, and therefore less volatility as markets consolidate and wait for those events. And that may, with different levels of volatility, you may adjust your trading strategy according to those levels of volatility. Excuse me. So we'll take a look at what we've got coming up. We'll use these two reports in here. So this is the macro matters. So this is our bigger picture. It usually runs to 3 or 4 pages, recapping last week, looking at this week. And then there's the macro summary, a one-page summary of pretty much that macro matters report. So we'll run through using that. This is published. If you're watching this live, you're new to Trade Day, or you're coming to these webinars and you've not been on these webinars before, we have the whole research section underneath where we live broadcasting this webinar today in the members area. So underneath we have the left hand column where we have the macro where we have the daily technical analysis, the technical analysis reports that we see here, which will come to you later, these market chartist technical analysis reports, and then in the middle column we have the macro matters and macro summary that are published over the weekend every week for the week ahead. And then on the right hand column we have our scrolling news feed from our partners, our Squawk service, Live Squawk. So we'll run through this now. US stock averages slipped last week. So we've been up, pretty much from August through September. Slightly lower, but it was only slightly lower. NASDAQ was down 0.6. S&P 3/10. Dow Jones Industrial Average is actually flat on the week. We saw oil prices jump higher. Gold went higher as well. And we saw to another new record high. And US Treasury yields went to higher yields driven by the short end was the main driver of those short end yields. As we saw, the main thing we saw last week was yields going higher, anticipation of maybe a less dovish. Remember, dovish is more likely to cut interest rates or less likely to increase interest rates. So a less dovish, so de facto more hawkish meaning more likely to raise interest rates or less likely to cut interest rates. Okay, so we saw a slight shift in anticipation where the central bank, the Fed, are going to be going forward from more dovish to slightly more hawkish. It doesn't mean they're raising rates. It means they're maybe not going to be cutting as aggressively as we thought. And the main driver of that, and we were talking about this all of last week, was this positive economy news is being seen as a negative for stocks, which is counterintuitive to what usually happens. Usually a strong economy, stocks go up, right? But the market is pricing in and wanting more Fed rate cuts. And the Fed rate cuts are going to come for us slowly. What the market really wants is a slow softening of the economy, a slow downturn in the economy. So it prompts the Fed to cut rates. Lower interest rates are good for then the economy to bounce back, but also then it's good for corporates, okay, lower interest rates. So that's what the market wants. But what the market is getting is better than expected data. So we had really strong GDP data came through the middle of last week. And then that meant that then maybe the Fed won't cut as aggressively as expected. And so stocks actually went down counterintuitively to some extent. So that's what's going on. So you have to be very wary of that and aware of that as we go into this phase as the Fed have started their rate cutting cycle, okay, at their last meeting. And as we go into the meetings into the end of the year. And then on the inflation side, which is the other sort of side of the economic coin, is that we see this PCE data we had, which is the Fed's preferred measure of inflation is sticky. It's staying at the levels above the 2%. Remember, the Fed uses, and global central banks often use 2% as their inflation targets. So it's sticky above that level in here. So that's a little bit of a concern that that's staying sticky. Inflation's not coming down. So the Fed wouldn't want to cut rates unless they felt the economy was rolling over and getting softer. However, the economy, as we said about this GDP data, is showing signs of strength. So, but the real concern is around the labour market, and we have a host of labour markets. So not only do we get this data strong in this, but then also Fed speakers, including Powell. Look, while Powell acknowledged the economy's resilience, he emphasised that monetary is not on a preset course. So, and then we also had Bullard talking about it last week, and Bostic talking about last week in here. Bowman speaking about it last week. So we had a lot of Fed speakers highlighting their concerns that maybe they've started to cut rates, but maybe that path could alter and they could be less dovish. So de facto, relatively hawkish. Look, the potential rate is relatively hawkish. Okay, still concern about inflation, and if the economy remains resilient, then they may not be as dovish. They may not cut as aggressively as the market's pricing in. And we certainly saw that with adjustment on the yield curve. We saw that the adjustment on the bond market, and we'll talk about that shortly. And we saw it on the very short end on the CME Fed Watch tool. We can see from the futures markets a less aggressive stance being started to be priced in with the potential for rate cuts from the Fed. And then so the focus on this week is going to be about, first of all, global PMI data that we get at the start of the week and the first half of the week from US, European, Asian, global PMI data for manufacturing, service and composite. But also we get a host of jobs data. So we get the ADP private sector data, we get the JOLTS jobs opening data, and critically on Friday we get the full US employment report with the unemployment rate and the non-farm payroll data. So that's going to be critical going into this week. So if we look in here on the calendar, it's fairly light for today, but moving further into the week, we do get the RBA, Reserve Bank of Australia, not going to really impact the markets we're looking at. But going into the week in here, consumer confidence, JOLTS jobs opening data. Tomorrow, we get the global manufacturing PMI on Wednesday, the first day of the month. We also get the US ADP employment change. That's the private payrolls number. We get that on Wednesday as well. Then we get initial jobless claims on Thursday. Then we get the composite and service sector global PMI data coming out on Friday, and the US employment report. So from really, Monday's fairly quiet in here. Tuesday, not huge, but we do get consumer confidence and the JOLTS numbers on Tuesday. And then we really start to kick in with that PMI, manufacturing PMI data on Wednesday, ADP employment change on Wednesday. Thursday, we get so it's Thursday's relatively light actually. And then Friday, the composite service PMI and the full US employment report on Friday. So really from midweek, starting to get really quite interesting in here. And there's the summary of all of that that we've just been talking about. So looking at today is relatively quiet in here. Trump is speaking at 1:15. Not sure what that's actually about. But we definitely be keeping an eye on it. I know he's meeting Netanyahu from Israel today, so it could be something. There has been rumors of an announcement being made potentially on the Israel-Gaza situation. We also get Fed speakers today, 1:30 Williams and 6 o'clock p.m. Bostic. So it's a fairly light day on the data side, but we do get Fed speakers through the session. And Trump speaking at 1:15, so certainly watching out for that. I'm not sure. Let me just see if I can find out what that is today, if we know what that's going to be about. But obviously, with President Trump and his approach to the media, it could be literally about anything. Let me see. Trump speaking today. Yeah, look, talk to Netanyahu. I think that's what it's going to be, guys. Talks today and then an announcement maybe later today. And there are rumors, that a deal is being done and there's potentially some kind of progress to be made. Okay, so we'll watch out for that. The other thing in it, or it could be around this. This is the main, the big focus going into the first part of this week. Trump meeting congressional leaders are shut down here, so it could be this. Okay, so he's meeting Republican and Democrat Democratic leaders of Congress in here because the government is teetering on a potential shutdown. I think in the next couple of days. But also look, he's also meeting Netanyahu as well today. So yeah, either one of those two, or maybe both. Who knows? Who knows? And maybe the press conference today. Trump to meet Democrats with both sides dug in on shutdown. So that's going to be key. A shutdown. Usually this gets sorted. My experience has been they get close to shutdown. I've been watching this get teetering on the edge of shutdown. Sometimes we get a shutdown for a day or so, and then the deal gets done and they extend out, and we don't go fully into any kind of government shutdown. So that's going to be a focal point, definitely the first part of the week. Stocks are rebounding in here this morning. Gold going yet higher to yet another new record high. Wall Street future and stronger footing as government shutdown concerns take centre stage. Yep, they're definitely doing that going into the first part of this week. Shutdown showdown, again from Reuters in here, but stocks up and the dollar down, gold going higher. Investors eye US government shutdown. Bond traders say rally hinges on jobs data at risk from shutdown. So all about the shutdown. I thought I'd just share this more out of interest than anything else. I'll stick this one in the chat if you can access this on Bloomberg. Magnificent Seven is passe. This group of AI stocks can replace it. If you're looking at, this is like longer term stuff on investing though. I just thought it was interesting that there's a big focus on the Magnificent Seven stocks, NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, and Tesla, and potentially, and they are a massive driver. Look, where are we? The AI trade expanding. Look, investment strategies based on the Magnificent Seven, responsible for more than half the S&P 500 index, 77 points rise since 2023. So the Magnificent Seven are obviously super important, but maybe they're about to pass the baton to some other stocks going forward. If we go a run round of the global exchanges going on the last 24 hours in here since the weekend, Nikkei in here down 0.7%, but the Hang Seng up in here nearly 2%, 1.89%. European exchanges also higher, with UK FTSE up about 0.2%, and the German DAX and the French CAC just nudging higher. And US stock futures overnight in here higher before we go into the cash market open, between 0.5 and 0.6% higher in here, 0.5% higher for the S&P, nearly 0.2% higher for the Nasdaq. Rebounding, having had those dips last week, almost already the dips we saw last week, almost already back up at the record high levels. This is what I was talking about on the Fed Watch tool in here. So pretty much still nailed on. Well, this is dipped. This was above 90%, just below 90% now. This is for the chances for a 25 basis point, 0.25% rate cut at the next meeting on the 29th of October. If we go to the next tab for the 10th of December, however, this is continuing to fall. So this was up at something like 80% only a couple of weeks ago after the Fed first cut rates in the last few weeks in September. It was pretty much nailed on. We were going to get 2 rate cuts by the end of the year. That has dipped now to only 68% chance of a second rate cut, and that's because of the concerns that the economy maybe is stronger than we first anticipated, and the Fed won't be as dovish. And that's been reflected as well with yields going higher. This is the 10-year yield pushing higher. Now we have just rolled a little bit lower in yields this morning, but they've been pushing higher over the last week, and we see that with then bond prices going down. Remember, bond prices and yields moving in opposite directions. So bond prices lower. And you can see we've got this bearish theme in here for 30 years, 10 years, and particularly this sell-off that we saw last week in the shorter end, the 5 years and the 2 years. Remember, the shorter end of the yield curve, the shorter dated bonds, more reflecting the tone of the central bank and where we're going on short-term interest rates. The longer end of the curve, more reflecting what we think about the economy. Okay, and if we look at the stock indices, yes, we were down back lower last week, but yes, we rebounded into Friday and then higher, as we said in the see those rebounds that we saw on Friday, and rebounding higher already this morning, almost back at those all-time highs, or if not at those all-time highs in here for the Nasdaq and the S&P. So bullish going into today. Well, I guess we're going to have all eyes on what Trump has to say regarding the shutdown, the talks on the shutdown, and also if we get anything out of the his meeting with Netanyahu and the potential for any kind of movement on what's going on in Gaza. So we'll be certainly focused on those the first part of the week, in fact, today, and then moving forward, we have those PMI data and the various employment reports we have through the week, culminating in the official US employment report on Friday. All right, guys, take care, stay safe. I'm going to wish you all a great trading day, have a great trading week, and we'll be back with you with another Bull versus Bear webinar tomorrow. Bye.